You learn, we grow, and with that understanding, we expect your active participation in this program, and we believe this session will help you to have better understanding of project finance. Further, we suggest you all to keep your mics on mute, and whenever necessary, you can raise your hand using hand icon. And in case you have any doubts, you can unmute your mics and ask your questions. You can also post your queries in the chat box, and we will address the same during the session. For today's session, we have our esteemed faculty, Dr. Hiren Maniar, with us. And his qualifications are BE, PhD, and MBA. And he has also done his certification in cost professional from AACA USA. He is coming with a huge, rich experience in academic and industrial experience. He has trained almost 6,000 practitioners on project feasibility, project cash flow management, and project cost management. He has also handled project finance and monitoring activities in large cement plants and power plants. Right now, he is a professor of finance and also a founding member of L&T Institute of Project Management. Before joining L&T IPM, he has worked in various reputed government institutions and has been a very regular visiting faculty to some finest MBA institutes. We welcome you, sir. And lastly, a recorded session of this training module will be shared at the end after to all the attendees. Over to you, Hiren, sir.
Thank you. Shall we wait for 2 more minutes so that we can get more number of participants?
That's not a problem, sir. We'll wait for 2 minutes.
I'll wait for
Thank
2 more minutes.
Thank you.
Good morning.
Good morning.
Hello, good morning. Hello.
Yes, good morning.
Good morning, everyone. We'll start this session within few minutes. We're expecting few more participants, so we'll start in few minutes.
So Pratik, shall we start now?
Yes, sir. Yes, sir, we can.
Okay. Thank you, Pratik, and good morning to all the participants. I believe that participants are joining from various countries, India, Lebanon, Saudi Arabia, and I don't know, maybe from other countries also. So, warm welcome to all of you to this online session on essentials of project finance. Well, I've been allotted 3 hours of time, and within 3 hours, I will try my best to give you the in depth idea about the different components of the project finance, which is not only useful for a contractor like L&T Hydrocarbon Engineering, but also for the vendors and the suppliers and other ecosystem partners of a project. So as we can see in the title slide, these are what I'm going to cover in my 3 hours of interaction with all of you. So first and foremost thing is we are going to understand about different types of financial statements, and during our discussion on financial statement, we will touch up how to do the financial performance analysis of any company or for any particular project. And then we'll go to the two other topics, which is illustrated on the right slide on this title slide. The first is working capital management. Well, this is a really area to be discussed in big detail. Within the working capital management, we'll discuss the components of working capital management like receivables, inventory, and the liquidity management. And finally, the third area that we are planning to discuss today is cost monitoring system. And the cost monitoring system in the working capital management is important at the time of executing any particular project. So before I start the session, what I request all of you, please keep your mobile or desktop from wherever you are joining handy, so that we are going to play some 6 questions, and the 6 questions are required to answer. Basically, it's a poll questions, and I'll tell you how to answer this poll questions. You require to open Mentimeter. So what is this Mentimeter website? What are the joining codes? All the details I'll share you later on. Main purpose of this conducting this poll is just to get overall idea that what are your perception about various types of questions, and this results of these questions will help us in understanding the subject in big detail. Yeah. Any question? Mudassar? Yeah. If you don't have any question, what I request all of you to please keep your mic in mute condition to avoid the background noise. In case if you have any questions, and if your system permits you, you can keep your mic in unmute, and then you can pose question or you can give some information if you want. Otherwise, there is a chat window facility. I hope you can pose your question through the chat option. Is it clear to all of you, all the participants? And I'm hoping my voice is loud and clear, and you can see this presentation without any interruption. If you have any issues, please let me know so that accordingly we can do some sort of adjustment. Okay, so with this, let me take you to the discussion point slide, and you can see these are the various discussion points that we need to discuss in this our 3 hours of interaction. So first point is essentials of financial performance analysis. And within this essentials of financial performance analysis, we are going to touch up 3 financial statements. And these 3 financial statements are balance sheet, profit and loss statement, and the cash flow statement. So before I take you to this 3 financial statement, I want to understand from all of you, how many of you are fully or partially aware about these 3 financial statements? You can give a reply in chat window. Yeah, I'm waiting for your reply. Anyone who is maybe partially or fully aware about this 3 financial statements? Not aware at all. That's what Noof has given answer. No issues. I'm going to cover up in bit details. Yeah. So I can get some response from some participants. Some of you are aware, some of you are not aware. I'm going to touch up all the 3 financial statements right from grassroots level, and hopefully it is going to help you in understanding this financial statement. So these 3 financial statements that we are planning to discuss are the balance sheet, profit and loss statement, and the third one is cash flow statement. So after going through these 3 financial statements, it is going to help us in understanding point number 2, and that is different types of financial terms that you must have come across while interacting with your seniors, while interacting with your ecosystem partner in handling projects. So it could be sales, OPEX, CAPEX, ROE, and profit margin. So all this different acronym we are going to touch up one by one, and then we are going to discuss the importance of each acronym. Then comes the point number 2, and point number 2 is project working capital management. Well, this project working capital management is again not new area for all of us, because almost daily we touch up some of the dimensions of working capital management. But we are going to discuss formally what is working capital, why it is important for each and every stakeholders of project, how to compute the working capital, and what are the areas that you need to keep in your mind while managing working capital for your project, either as a vendor, supplier, subcontractor, or as a customer. So that we are going to cover up under project working capital management. And finally, the third but most important point is project cost monitoring and control by using earned value management. So before I start something about earned value management, how many of you are aware, again partially or fully, about EVM, which stand for earned value management? Are you aware about earned value management? Maybe partially or fully. Just type your answer, I will understand. Just type your answer in chat window. I'm waiting for your reply. Are you aware about EVM, earned value management? Partially, that's what some of you have given answer, and Avinash has given answer yes. So maybe Avinash may be aware, and some of you have given answer few basic concepts. Some of you are partially aware, some of you are not at all aware. No issues. Again, I'm going to cover up this earned value management in bit detail, and there is one case study about cost monitoring and control by using earned value management. And today we have selected one oil and gas wallet platform project, and with that project you will come across that how to use this EVM in measuring the monitoring and control of not only the cost but schedule as well as from the scope perspective. Veera Kumar, if you can put yourself in mute condition so that we can avoid the background noise. Thank you. After the discussion points, let me take you to the learning objective. So this learning objective, as you can see in the next slide, slide number 3, these are the key takeaways that hopefully participant can jot down at the end of the session. So some of the learning objectives which should act as a, the key takeaways for all of you. First and foremost thing is to understand this 3 financial statement in bit detail. It's not merely the word, but what are the different components which are there within the balance sheet and P&L statement and cash flow statement, and how to interpret different types of terms and how to read. Most important thing is how to read this financial statement and how to use this financial statement to get the financial performance of any company or for any project per se. So that's what the first objective of this session. Second is how to find out the growth potential triggers, whether it's a revenue trigger or the cost reduction trigger or the profit margin trigger. So that part is acting as a second learning objective. Third is how to assess the working capital and liquidity for your company, for your project. That's what the third key takeaway. Fourth is understand different aspects of project cost management, because project cost management is basically a process, and as per PMBOK, you can divide project cost management in 4 different areas. That is resource planning, cost estimating, cost budgeting, and cost control. By the way, I just used one word, PMBOK, PMBOK. Are you aware about PMBOK? PMBOK. What is the full form of PMBOK? If you are aware, you can put your answer in chat window. If you're not aware, I will tell you the full meaning of PMBOK. Are you aware about PMBOK or PMBOK? I'm waiting for your reply. PMBOK, okay, Nawaz has given no answer. So PMBOK stand for Project Management Body of Knowledge. It's not PMP manual book, Mohammed. It's Project Management Body of Knowledge. Now, this Project Management Body of Knowledge is basically the knowledge framework being prepared by Project Management Institute, that's PMI USA. And currently in the market, you can find the 6th version of PMBOK. If you are aiming to crack PMP, now PMP stands for Project Management professional. That's basically the certification course or certification exam being conducted by PMI USA. Then in that case, you have to have knowledge of all the knowledge areas of PMBOK. So one of the knowledge area which we are planning to discuss today is cost management. So how many of you are PMPs, or how many of you are intent to clear PMPs? How many of you are already project management professional? Jai Sima, if you have any questions, you can ask question by keeping yourself in unmute condition, or you can put your question in chat window. So it seems that maybe some of you are planning to crack PMP, or you are planning to prepare for PMP. Hopefully today's lecture is going to be useful in preparing yourself for one of the area, and one of the knowledge area is project cost management. So that's what we are going to focus today. And then apart from project cost management, today we need to take a deep dive under cost monitoring and control area. Well, this cost monitoring and control is possible with various methods, but the method or the technique which is quite versatile being used by most of the project contract company as well as various project firms are earned value management. And that's what we are going to focus about, earned value management. So EVM will help you in terms of understanding how to control cost in typical EPC construction project. And the perennial problem that most of the project ecosystem partners face is a cost overrun problem. How to effectively forecast cost overrun, and not only the forecasting of cost overrun, but how to control the cost overrun. So the forecasting and control, these are the two aspects that we are going to touch up with earned value management. So these are some of the learning objective that we are expecting participants to carry in form of key takeaways at the end of the session. So with this session objective, now let me start the first point for which we have assembled today, and that is financial statement analysis. So there are three types of financial statements are there, as you can see. These three financial statements are the balance sheet, income statement, which is also called as the profit and loss statement, and the third one is cash flow statement. So balance sheet basically cover up two aspects for any particular project or for any particular company, that is assets and the liability. So we will discuss what is asset, what is liability later on when we go for the balance sheet discussion. Income statement tells you something about the expense and the income, and cash flow statement tells you the idea about the inflows and outflows in terms of the cash position. So these are three financial statement, and this three financial statement analysis is going to give the complete picture about the financial performance of any particular project or for any particular company. So now let's start with the first poll question. And the first poll question is, what is the objective of financial performance analysis of in your firm? Now for that, please open the website which is mentioned here. And the name of the website is www.menti.com. This you can open either in your mobile, desktop, or laptop. Please open up this menti.com website and keep it open till the end of the session, because several questions I'm going to ask. Okay, so I hope that you might open this website www.menti.com. Now, after opening that website, in order to give answer to this question, in that website, please type this code 286000068. And then you need to answer. The moment you give your answer,
and you go to point number 107.
to give the answer, the poll results will come in the screen. Please put your answer. One candidate is given all of above. Yeah. Please hurry up. code is already mentioned, and this is only the one-time effort you need to do. One-time code you need to enter, and please keep this website open till end of my session. So out of 56, I can see 15 participants have given answer. Please hurry up. 16 participants have given answer. As you can see on your right bottom side, you'll get the counter meter, how many participants have already taken part in this question number 1, poll question number 1. So currently it seems that all the options are possible to analyze with the financial performance analysis, and that's the reason that this financial performance analysis is being preferred in your company, and that is enhancing liquidity and profitability, reduction and optimization of cost, managing working capital, and managing project financial risk. So these are the different types of objective that one can identify with the help of financial performance analysis in your company. And I will go with majority of your view. I completely agree with you. What we will do at the end of the session, whatever the results we get, we will also share those results with all of you, and you can use it maybe for the future reference. Okay, so please don't close yet this website, menti.com, and every time this code will come, in case if you're logged out, again you need to open this website for the next question. Again, you need to type the same code, okay? For time being, you keep this website open, okay? And there is no need to close it. In case, accidentally, if you closed it, you need to redo the same thing, and I'll repeat this code again and again for each and every poll questions. So thank you. Now let me straight away take you to the presentation. So I can understand that based on the poll results, it could be managing liquidity, managing financial risk, enhancing profitability, and reduction of the cost for the project or for the company. That is what the foremost objective behind this financial performance analysis. Now the main question is why this financial statement is important for all of us, because financial statement will tell you something about where the money comes in company's kitty and where money goes and how it is being effectively utilized by your company. So it's basically the cash movement that the company is handled, and that how this money is moving in your company, how the money is going out from the company, and that can be found out with the help of balance sheet, income statement, and cash flow statement. So if you just go by types of financial statement, the balance sheet tells us company's net worth. Now the net worth, I'll tell you in the balance sheet, is nothing but what is the value of any company. So you can always make the valuation of any company by studying the balance sheet for the respective company. So balance sheet, why it is called as the balance sheet? Because both the sides, that's your left side and right side within the balance sheets, are always equal, and that's why it is called as balance sheet. So assets are usually equivalent to liabilities plus shareholders equity or the owner's equity. That's what the equation that we need to discuss when we go for the balance sheet discussion. Second is income statement. Well, income statement is nothing but it basically gives the idea about the revenue and the expense picture. And at the end of the revenue and expense picture, it tells you something about the profitability idea or how much loss your company is making over a period of time. That is basically income statement, or sometimes it is also being recalled as profit and loss statement. So there are two names are there. First is income statement and second is profit and loss statement. And the most important thing is cash flow statement. So cash flow statement always enables any evaluator to find out change in cash movement in the company, because some money is going to go out from your company's account, some money is going to come in your company's account or your project account, and finally at the end of the day, what is the net cash flow? And this net cash flow is also called as the liquidity. Now that liquidity or net cash flow is nothing but the difference between inflow and outflow. Sometimes your inflow is less or inflow is not at all there and outflow continues, and that gives you the idea that your company is not having enough cash on the book, and temporary there is a cash crunch. I'm not saying crisis, but there is a temporary event called cash crunch. In order to avoid this cash crunch, what are the different options that you require to exercise? This point we will discuss under the statement of cash flow. Now, after this, let me take you to the balance sheet. So balance sheet, as I told you earlier, it gives you the idea about the snapshot of company's financial position at specific point in time. Now, specific point in time is nothing but usually company is declaring results 7 times in a year. So I'm asking which are the 7 times or the 7th occasion that company is usually declaring the results, and one of the result is balance sheet. Can you please tell me? During how many instances in a year company declares the result? How many quarterly results company announce in a year? I mean in a calendar year or a fiscal year? No, if you are right, quarterly. Each quarter means 4 quarters are there. 4 quarters, so 4 quarterly result. Then comes 2 half-yearly results, and one is a big one that is called as annual result. So 4 plus 2, that's 6, plus annual result, 7. All the companies around the world, whether you are from Saudi Arabia, India, Lebanon, or from wherever you may be, companies declaring results 7 times in a year. And this is what the meaning of balance sheet. It tells you that during each occasion, whenever the company announces the result, it tells you the financial position of your company just by studying this balance sheet. So, as I told you earlier, balance sheet is nothing but it is basically the two sides which is usually same, and that's why it is called as balance sheet. So first is assets and second is liability plus shareholders equity. So now let's study how this balance sheet format looks like. So now let me take you to the balance sheet format, and here is the balance sheet format. Well, on the left side you can see assets, and then on the right side you can see the liability plus shareholders equity. Now let's discuss one by one. Assets you can divide in 2 parts: current assets and fixed asset. So what's the difference between current assets and the fixed asset? Current asset is an asset which one can liquidate at any period of time. That's why it is also called as liquid assets. I'll also tell you what are the different components which you can put under the current assets. But for time being, please remember this. Current asset is an asset which one can liquidate at any period of time. That's why the second name of current asset is also liquid assets. And opposite to current asset is fixed assets. A name itself indicates that it cannot be liquidated as and when company wants. Company required to wait till company can liquidate it. Depends on the buyer, depends on the price which company wants, and depends on the timing. So time, the next buyer, and the price. Till you are not getting these 3 things right, you can't liquidate this fixed assets. That's why it is also called as illiquid assets. So please remember one thing: current asset, because it has ample liquidity, as and when one wants, they can easily liquidate it. That's why it is called as liquid assets. Fixed asset, because of this constraint which I mentioned to you, it is also called as illiquid assets. There are 2 types of fixed assets: tangible assets and intangible assets. We'll discuss it later on, but let me tell you the definition or the difference between a tangible assets and intangible asset. Tangible asset is an asset which you can possess physically, and opposite to tangible asset is intangible asset. You can't possess this asset physically. It is also called as virtual assets. So that's what the difference between tangible assets and intangible asset. When we go for the discussion of fixed asset, I'll throw more light about what are the assets which you can consider in the form of tangible assets and under the intangible assets. Now let me take you to the right side. And the right side, we have two types of liability: current liability and long-term liability. Current liability is also called as instant or the immediate liability, which you require to honor, because that's what the obligation one carries in honoring that liability. And usually the time frame is within 90 days or 1 quarter. Within 3 months or 90 days or 1 quarter, you require to honor your obligation which you have committed to various ecosystem partners. We'll discuss it later on under the current liability. So it is also called as immediate liability. Long-term liability is a liability which is going to give some time to a company in honoring that obligation. That's why it is called as long-term liability. Typically, right from 4 months till 4 years, 5 years, that's what the time frame you have, and that's what is called as long-term liability. Now, if you just take these two types of asset, current asset and fixed asset, if you sum it up, you'll be getting total assets. Similarly, if you take these two types of liability, current liability and long-term liability, after summing up, we are getting liabilities. Asset minus liability, and that is called as a net worth. And this net worth is nothing but the shareholders' money, and that's why the shareholders' money is also part of liability. Why? Because that particular money in form of net worth is always there in form of shareholders' reserve, and the shareholders reserve is always being managed by the company. And that's why, considering that thing, it is not company's money but it is shareholders money. That's why shareholders equity is always being considered along with the liability. So now you might have understood that total asset minus these two liability is net worth, and by putting this net worth here, you are also balancing on your right side, and that's why left side, that is asset, right side, which is liability plus shareholders equity, is also becoming same, and that's why it is called as balance sheet. So this is what, as per the balance sheet format, how it is called as a balance sheet. I hope you would have got some conceptual idea under the discussion. If you have any questions, either you can keep yourself in unmute condition and then you can ask, or you can always put your question in chat window. Okay, now let's go in bit detail about the current assets and current liability. So here are the details of current assets component, and you can see in the slide. The first is whatever the handy cash which is available with the company, available with any particular project, that is what the component under the current asset. Second is the money which is available in the bank account, that's point number 2. Point number 3 is the inventory. Now, inventory is not new word for all of us. So if I ask a definition of inventory, what do you think? What is inventory? How can you define inventory? Inventory, can somebody define what is inventory?
This is stock available in the warehouses.
Okay, so Farooq, you're right, but this inventory is there in a different form. For example, inventory means whatever the material that you are storing in your store, that is called as stock inventory. After issuing the stock to your project site, it is called as work in progress, and the work in progress is also called as semi-finished activity or semi-finished products. And once you complete that activity and finally you plan to bill it to your customer, it is called as finished activity or finished goods. So that is the third part of inventory. So inventory, in short, is raw material which is lying in your store, semi-finished activities which is called as a work in progress, and finally the finished activity. So these three things, Amal, Abdullah, you're right, these three things are basically part of inventory, and inventory is part of current assets. Then comes the debtors. Now let me first of all explain what is the debtors. This debtors is nothing but it is outstanding from your customer. What happens once we complete our job and once you bill it to the customer, we need to give credit period to our customer. 30 days, 40 days, 50 days, depends on how many days of credit you are agreeing with your customer. So within 30, 40 days, say for example, if this 30, 40 days is credit period, if customer is expecting to make payment to you, so till you don't receive this payment in your project account, it is called as receivables. And that's why this receivable is part of current asset. As per the balance sheet, this receivable is called as debtors. Why it is called as debtors? Because debtors are nothing but basically it's the outstanding from customer which you're expecting to get from your customer within 30, 40 days. So that outstanding from customer for the previously submitted milestone invoice or previously completed work which you are now planning to claim from your customer. So that is called as debtors. Then come short-term investment. Short-term investment. The short-term investment is nothing but if temporary some money is available and if your treasury is investing that money, then whatever the short-time investment your treasury is doing, and finally whatever the interest or the profit that that investment is going to fetch, that is what compound number fifth in the form of investment. And finally, the most important thing is prepaid expense. Now, this prepaid expense is nothing but advance. If you're given to your vendor, if you're given to your supplier, if advance, if you're given to your subcontractor, I mean, to any of your ecosystem partners, that advance, either interest free, interest bearing, so that advance which you paid to your ecosystem partners, that is called as prepaid expense. So these are the 6 components of current assets. And if you make a study of your project or of your company, you are going to identify maybe the 6 components which is going to be part of your current assets. If you have any questions, as usual, you can ask your question. After the current assets, let's go to the fixed assets. So as I told you earlier, the difference between current asset and fixed asset is the fixed asset is illiquid asset, while in the previous slide, the current asset is called as the liquid assets. Now, the fixed assets you can divide in 2 parts, as I told you earlier. First is the tangible assets, and second is intangible asset. Now, before I explain to you about the tangible fixed asset, the intangible fixed asset for a company, let me take a personal example, or the example which applies to you and me. Whatever the investment that you put in property, whether the residential property or commercial property, that's a perfect example of tangible asset. Why? Because tangible asset is an asset which you can physically possess. So example is land, building, property. These are all plenty of example of tangible assets. Intangible asset is an example, mainly from our investment point of view, is nowadays we are buying shares from stock exchange. We are buying mutual funds from various mutual fund companies. People are also buying various commodity in ETF form like gold. ETF, by the way, stand for exchange traded fund, or in some of the countries including India, you can also buy gold in E form. So if you buy the asset which is in paper form or which is in paperless form, nowadays in digital form, that is called as intangible asset. So if I ask a very simple question, whatever the investment that you are putting at your personal fund, percentage wise, you can tell me how much percentage you park in form of tangible assets and how much you are parking in form of intangible assets. Intangible asset, as someone has raised a question, intangible which cannot be touched. Absolutely. Intangible means it's basically the virtual asset. Okay. Intangible means you can't have a physical possession. So that's what the difference between tangible assets and intangible assets. Sometimes people are also calling tangible asset as a hard assets and intangible assets soft asset. I think this word you can easily remember. Tangible means hard and intangible means soft assets. Okay. So goodwill, Farooq, you are right. Goodwill, brand, copyrights, patents, and that's what is mentioned as an example. Okay, these are all plenty of example of intangible asset, but I was mainly planning to ask the question that how much of your personal investment you are putting in form of tangible assets and intangible assets. Some sort of percentage, if you can tell me. If 100 is your investment, out of 100, how much percentage we usually put in tangible assets? AQ Khan, you're right. 70%, including myself, I'm putting 70 to 90% in tangible assets and maybe 10 to 30% in form of shares, mutual fund. You can buy gold in e-form or ETF or whatnot. So plenty of examples are there. And nowadays, how can you forget Bitcoin? So Bitcoin is again an example of intangible asset investment. So fixed assets you can divide in two parts. That's the tangible assets and intangible assets. And in case of a tangible asset, whatever the asset reduction take place, that asset reduction is called as depreciation. And what asset reduction take place in case of intangible asset, that is called as amortization. So depreciation and amortization, you can understand like this. Depreciation basically reduction of asset valuation of your tangible assets. Amortization is reduction of your asset valuation of your intangible asset, and that's how this depreciation and amortization, these two concepts you will come across when we go for the income statement discussion. So after the fixed assets, let's go to the current liabilities, and you can see these are the different types of current liabilities. So first is the creditors. Now these creditors are nothing but our trade payable partners, and within the trade payable partners, your vendor, supplier, subcontractor, service provider, who have supplied various product, raw material or services on credit basis. Like if you have received material from your material supplier and the payment you are supposed to deliver within 30 days. So whatever the payment obligation that your company carries to that material supplier, which we need to deliver within 30 days of time. So that is called as basically the payable. It is called as trade payable or the accounts payable. Now, as we discuss in the current assets, whatever the prepaid expense or whatever the advance which you already paid, whatever the balance payment for which our vendor, supplier, subcontractor has given credit to us. So that's why they are called as creditors. And in the current assets, you must have observed that debtors are basically your customer and the creditors could be your vendor, supplier, subcontractor, or your service provider. So creditors are basically also called as accounts payables or the trade payables or the bills payable, whatever the word which is popular in your company. Second is the salary payment to the payroll employees, those who are working in your company, along with whatever the benefits that you have. So that salaries and benefits is second components of current liability. Third is the bank overdraft. What are the short-term borrowing if you have taken? So short-term borrowing is part of current liability. And then whatever the loan repayment that we need to deliver along with the interest payment. So these two are also part of current liability. And finally, the most important thing is accrued liabilities. And within the accrued liabilities, it could be in form of the wage payable, the service consumed, or maybe the provision on the name of tax, provision on the name of salary deferment, provision on the name of dividend. So whatever the provisions that you are making and for which you are carrying that liability, so that particular accumulated liabilities can be called as accrued liabilities. Here, one more point that you can put, and that particular point is the disputed items. And within the disputed items, work done but not paid because of scope dispute. If you have with your customer, if you have with your other ecosystem partners. So disputed item is also part of accrued liabilities. And finally, if you have taken any advance from your customer, then that advance, which is called as a mobilization advance or the stage advance. So mobilization advance and stage advance is also part of accrued liability. So within the accrued liability, there is a big list is there, and this the complete item is part of accrued liabilities under the current liabilities. So after this current liabilities, let me take you to the sample balance sheet. And there is one company called X, and you can see in this particular company, assets are there of 163.4 million, and liability is also there of 163.4 million. Now let me explain one by one that this 163.4 million is basically combination of two types of asset, that is the current assets and the fixed asset. So out of 163.4 million, almost 49 million is current assets, and fixed asset is there in the range of maybe I would say maybe if you just remove the 49 or 50, it is coming 124 million. So roughly 124 million, that is coming the fixed asset. So I want to understand from all of you, what is the percentage distribution out of the total asset in form of current asset and fixed asset? If you can tell me percentage. 163 million is having what percentage distribution of current assets and the fixed asset? Well, somebody has raised the question, AQ Khan has raised the question, and that is about other long-term assets. Within other long-term assets, it could be the money being parked in shares, mutual fund, and similar types of investment. So that's a perfect example of other long-term assets. Clear, AQ Khan? My question now to all of you is, what is the percentage of current assets? What is the percentage of fixed asset within the total assets? 30% current asset, you're right, Jayasima, and 70% is the fixed asset. Good. And this is what you're going to find. It could be between 2080 to maybe 2575. So most of the companies are having large chunk of money being put in the form of fixed asset, and smaller amount of money being put in the name of current asset. The reason is current asset can give lesser return, and the fixed asset or the long-term asset is always give better return in a longer term. And that's why this is what the same percentage distribution you are going to find even in your company also. Current asset is usually less. Usually it is 1/3 or 1/4 of the total asset, and the remaining is the fixed asset. Similarly, let's go for the liability. And within the liability, current liability is 55 million. And if you put the long-term debt and non-current liability, it is coming roughly 42 million. Now, total liability is 98 million. Now, as I told you, the difference between total assets minus total liability, that is 98.1 million, is called as shareholders' equity. So if you take difference of 163 from 98, it is likely to be 65 million. Now, the 65 million is called as shareholders' equity. It means this is not our money. This is whose money? This is shareholders' money. But this money being managed by respective companies' treasury. And this treasury is investing this money in various types of investment. So that's why it is called as a liability, because it is not our money, it is shareholders' money. So after including 65 million on the name of shareholders' equity, along with this total liability, you can see the total liability after including shareholders' equity is also coming same, that is 163 million. So asset is 163 million, and after including shareholders' equity, liability and shareholders' equity is 163 million. And that's why it is called as a balance sheet. Why it is called as balance sheet? Because both the sides are same, that is assets, and liabilities and shareholders' equities are same, and that's why it is called as balance sheet. Now let me ask question. If any company is on the verge of bankruptcy, so what do you think in that company, what could be the net worth? The net worth would be positive, or the net worth would be negative for a bankrupt company? Have you understood my question? If any company is on the verge of bankruptcy, and in that scenario, if you just study the net worth for that company, what are the chances of net worth? Will it be positive or negative? All of you are right, negative. Now, as you can see that in this example, the net worth is positive, that is 65 million. And that's why this company is not a bankrupt company, but this company is having very good financial condition. So just keep eye on net worth. If net worth is going up, it indicates that financial condition is improving. If the net worth is going down, and if it is inching towards zero, it means the company's financial condition is deteriorating. So just by keeping eye on net worth, every time whenever company announce the result, I told you 7 times company announce the result, and accordingly based on the change of net worth position, you can find out what is going to happen to that company just by focusing on balance sheet. So net worth is not the only thing that you require to keep in your mind for checking the financial performance of any company. Second point, which is really important for all of us, is debt. And you can see that the long-term debt is currently 34.5 million. Now, if the debt is going up, it indicates that interest expense is also going to go up. But if company is reducing the debt, and that indicates that more money is going to available with shareholders' hand. So along with the net worth, the second point which is required to be evaluated every time whenever the company announces the result is the change of long-term debt. And of course, other things are the receivables that is outstanding. If the receivable is going up, again it is indicating that customers are not clearing the payment easily, and because of that, the current asset is piling up. So again, this point we are going to discuss in the working capital management, and something from the payable point of view. Payable is nothing but outstanding that the company is having to vendor, supplier, subcontractor. So if the payable is going up, it indicates that the outstanding is going up. And if outstanding is going up, then it indicates that this company is having short-term solvency risk, or this company can default it in honoring payment to the vendor, supplier, subcontractor. So whenever you try to evaluate your customer, your project, or your company, these are the various facets you require to keep in your mind. And this discussion is so in depth, we can discuss for the whole day, that much of detailings are there. I don't want to spoil your time, so you require to just focus about the net worth. I told you point number 1. Point number 2 is the change of debt. Point number 3 is the change of receivable, and point number 4 is change of payable. So these are the 4 points which you require to keep in your mind at the time of evaluating any company, any competitor, or your ecosystem partner, of course, your project's performance. So after this balance sheet, the next point, which is again very much important, is income statement. Income statement always tells us something about the profitability of any company. And income is basically a combination of revenue minus expense. Revenue minus expense. Now, often in your review meeting with your higher ups, review meeting with your project stakeholders, you must have come across with margin analysis. So there are 4 types of trigger you require to keep in your mind just to assess your project margin performance, your company's margin performance. So first is the gross margin. Gross margin is nothing but it's a gross profit divided by sales. I'll tell you in the next slide how to compute gross profit. Second is operating margin. Operating margin is operating income divided by sales. Then comes ROS, return on sales, which is net income divided by sales. And then comes ROE, return on equity, that is net income divided by shareholders' equity. So before we go to the next slide and we discuss about the different types of margin analysis, how many of you are familiar with this type of words while measuring the financial performance of your project? Or you must have come across with this particular words during your project review meeting. Are you aware about gross margin, operating margin, return on sales, return on equity? Do you use this type of parameters for measuring the financial performance? Okay, I can see yes answer from most of the participants. So it's really good. Now, only thing is that you require to understand how to compute these different types of margins. So let me take you to the typical income statement format. And you can see the typical income statement format, and universally, including Fortune 500 companies are using this income statement format. So wherever the plus sign is there, it indicates income. Wherever the negative sign is there, it indicates expense. So basically it's outflow. So plus sign is inflow, minus sign or negative sign is outflow. So revenue minus cost of revenue. Now, if you are a manufacturing company, then obviously the word which you need to use is COGS. COGS stands for cost of goods sold. If you are a project company, then the word that we are quite familiar to use is OPEX. OPEX stands for operating expenditure. Now, what do you think? What we should consider under the COGS as well as under the operating expenditure? Which are the main components that we should consider under COGS or OPEX? That is going to be called as cost of revenue. It means for producing revenue, where you are supposed to spend in form of cost. If you can give me few components idea. If you know, then you can write your answer in the chat window. Well, first is the material. Second is salaries to your employees. Third is subcontracting charges in form of labor payment. Fourth is various types of overheads that you require to consider, like project overhead, business overhead, and couple of type of other expenses. After deducting all these 3-4 components, depends on applicability in your project, in your company, you are likely to get gross margin. So gross margin is nothing but, in short, revenue minus OPEX. Yes, rent can also come. Revenue minus OPEX or revenue minus COGS depends. If you are from manufacturing firm, please use COGS word. If you are from project company, please prefer OPEX. We are likely to get gross margin. And from gross margin, we are likely to deduct sales and marketing expenditure, R&D expenditure, that is research and development expenditure, general and admin expenditure, and then depreciation and amortization. As I told you, depreciation applies for tangible assets, amortization applies for intangible assets. So from gross margin, after deducting this 4-line item, we are likely to get EBIT, or it is also called as operating income. EBIT full form is earning before interest and tax. Earning before interest and tax. So first of all, if you earn any income on the name of some short-term investment, so that interest that you earn, that you need to add. And then if you have paid some interest for whatever the borrowing that you have taken, that interest we need to deduct. So this basically 2 types of interest. Interest if you earn, that we need to add. Interest if you pay to your lender, to your bankers, to your finance institution, that you need to deduct. Then we are likely to get EBT, and EBT stands for earning before tax or net income before tax, whatever the word. Now here there are 2 line items we need to deduct. First is the income tax, and second is extraordinary items for which you have not made any provision. For which we have not made any provision. So this is basically the accrued liabilities, if you remember, something which we discussed under the current liability. And finally, we are likely to get net income. Net income is also called as PAT, and PAT stands for profit after tax. So tell me, how many of you are following this format for income statement preparation of your project or for your company? Universally, this format is being followed by Fortune 500 and around the world. It doesn't matter, you come from whatever country, all the companies should follow this format. This format is there in line with GAAP standard, that is generally accepted accounting practices. It is called as GAAP. So how many of you have seen this format for your income statement competition in your company? Just give your answer yes or no. Are you following this format? I'm waiting for your reply. Okay, so Jaisima has given yes answer, and other participants also given yes answer. Now, let me take you a sample income statement. And in this sample income statement, there are three companies are there. And you can see this three company, X company, Y company, and Z company. So all these figures are there in $1 million, million US dollar in fact. So revenue is 39.5, 5.5, and 405. So you can see the biggest one is Z company, and the revenue is 405 million. And the smallest is Y company, you can see 5.5 million only. So first is, let's deduct cost of revenue, that is OPEX of COGS. And then we are having a gross profit. So gross profit is 99.4, 3.4, and 25.5 million dollars. Then the sales and general and other applicable admin expenditure, that's we are deducting. R&D expense and depreciation and amortization we are deducting. So finally, we are like to get operating income. And operating income is coming 22.8, 1.9, and 9.4. And likewise, you deduct the other line item like interest and finally the tax. So net income is coming 8.1, 1.3, and 13.4. Let me ask very simple question to all of you. Suppose if you are an investor and if you have to just take an investment call just by comparing these three company income statements, what do you think, in which company it's worth investing out of these three companies? In which company it's worth investing out of these three companies? And for that you require to keep your gross margin and operating margin in your mind before taking an investment call. So most of you are given your preference for X company. Even though that company, the revenue looks quite robust, but then also none of you prefer Z company. The reason is margin point of view, X company is better, and all of you are right. If you see Y company, 62%, Z company, 25%, Y company operating margin is 34%, and Z company 6%. What about X company? What about X company? Let me ask this question to all of you. What is the margin, operating gross margin percentage in case of X company? Let me revisit the previous slide. Gross profit is 25.5. So if you just divide 25.5 with 39.5, similarly, what we did here, we have divided 3.4 with 5.5. Tell me, what is the gross margin percent in case of X? Let's compare X and Y, because by comparing X and Y, you'll get an idea that which company's margin is better. So can you please tell me 25.5 divided by 39.5. I'm waiting for your reply. 64%. And here if you see 62%, and that's the reason that I'm answering question that somebody has raised, why X, why not Y and Z? So you can see that X company is far better because margin point of view, it is giving you 2-3% higher compared to Y company, and Z company has got the lowest margin. And that's why if I'm an investor, obviously just by income statement comparison, obviously I should put my money in X company. But that is not the only criteria I should keep in my mind before putting my investment in X company. I also require to study the balance sheet, cash flow statement, and then you can get a holistic idea. But just based on the income statement, as per this discussion, it is worth for an investor to put money in X company compared to Y and Z company. So Tamadur Arif has asked a question. Okay, as an investor, we are looking for the gross margin. No, investors are not only concerned about the gross margin, investors are concerned about the net income margin, that's the PAT margin, gross margin, as well as operating margin, mainly from the margin analysis point of view. But you also require to consider other parameters into the mind, like as we discussed in the balance sheet, what is the net worth, whether the net worth is going up or going down. What about the debt, whether debt is going up or going down. What about the receivables, what about the payable. So what I mean, from each and every financial statement, you require to cherry pick couple of important aspects. In balance sheet, we discuss net worth, we discuss trade receivables, we discuss trade payables, and the fourth point that is required to be considered is the debt position. Change of all this thing over a period of time. Under the income statement, of course, the revenue, it is called as the top line growth, and the net income, which is called as the bottom line growth. And finally, at what percentage company is making money on the name of gross margin, operating margin, and the net profit margin. So these are the 3 points you require to select at the time of evaluating your income statement. Is it clear, Tamodar? Arif? I am hoping that you got your answer. Okay. Now, the third and the most important thing is the cash flow statement. It's very simple. Cash flow statement tells you over a period of time what is the liquidity moment in the company. And as you can see, this is a bucket, and the cash flow statement is nothing but like a bucket. So money which comes is called as inflow. Money which goes out, it is basically your cash is draining, it is called as outflow. So of course, from the bucket principle point of view, inflow should be more and the drainage should be less, and the drainage is nothing but outflow. And find the difference between these two is called as the net cash flow. So you can imagine that if inflow is more, outflow is less, you can imagine that bucket is going to retain something, and that retain is called as net cash flow. So if your inflow is less and outflow is more, what will happen? The bucket will empty out, and if bucket empty out, it means you don't have enough cash, and then temporarily you are having cash crunch crisis. So that's why this bucket concept may be helpful to you in understanding the cash flow statement. But this bucket has given you 3 different activities: operating activities, investing activities, and financing activities. Let's discuss one by one. And these 3 types of activities are there in form of 3 different components. So first is operating activity. So biggest inflow for operating activity, the cash being received by you in terms of selling of your goods and services to your customer. And the biggest outflow is the payment that you are delivering in producing the goods and services. So what do you think in outflow, where you are going to spend, so that finally you can deliver goods and service to your customer? So moment the goods and service being delivered to the customer, you are likely to get inflow in the future. In outflow, what do you think? What are the different sources of outflow under the operating activities? First is the payment to your material supplier, payment to your vendor, payment to your subcontractor, payment to your employees on the name of salary, and likewise. So, these are the list of outflows that you can consider under the operating activity. And finally, if you take difference of these two, this is called the net cash flow from operation. Investing is nothing but whatever the surplus money which you have it, and if you want to park your money in either a fixed asset in form of tangible assets or intangible assets. So first of all, the outflow take place in terms of putting your money in form of investment, in form of property, plant, equipment, land, or whatsoever. And once you sell that particular investment in the future, then we are likely to get inflow. So investing activity is receipt after redemption of that investment minus investment that was being put under the property, plant, and equipment, that is going to give the cash flow from investing activity. And cash flow from financing activity is cash received from issue of debt or capital stock. And this is nothing but we are raising money in form of borrowing, and then whatever the money that we are repaying to our lender along with interest plus dividend that we are paying to our shareholder, that is called as outflow. So difference of these two is called as a cash flow from financing. So as you can see that there are 3 types of net cash flow: net cash flow from operating, net cash flow from investing, and net cash flow from financing activity. Project is mainly responsible for cash flow from operating activities. Your finance and accounts is responsible for managing cash flow from investing as well as cash flow from financing activities. So investing and financing activities being considered by your F&A, and project is responsible for cash flow from operating activities. Now, if we just add these three types of net cash flow, we are likely to get net change in cash for the period. So these are the different components of the cash flow statement. Now let me take you to the sample cash flow statement, and you can see the sample cash flow statement. Well, net income for this company is, you can imagine that it is 4.22 million. And if you go by the operating activities, so wherever the figures are mentioned in bracket, that indicates outflow. Wherever the figures are mentioned without bracket, that is called as inflow. So there are 4 inflow and only 1 outflow on the name of change in accounts receivable, means account receivable has increased. And finally, if you just do the subtraction and addition, it is coming 7.85. That is basically the total cash flow from operating activities. Similarly, the investing activities, you can see that this company is going for investment, and company has not gone for any significant inflow in case of investing activities, and that's how here it is coming negative. And finally, in case of financing activities, it is coming partially positive, 87,567. And effect of exchange rate in the sense of the dollar versus volatility against rest of the foreign currency, so that is basically negative 45,923. After adding this net cash flow from operating, net cash flow from investing, net cash flow from financing, and the change of exchange rate, finally it is coming 2.57 million. So 2.57 million indicates what? That is the cash balance position of this company, and that is called as the closing cash balance position. Suppose if it was the figure at the end of any particular quarter, then for the next quarter it becomes the opening cash position. So just by focusing on the change of cash and cash equivalents number, we can find out that whether this is going up or going down, and accordingly some sort of further investigation is required in the overall cash flow statement. So now if I just do a quick recap of the 3 types of financial statement, what do you think, which are the 3 financial statement that we discussed? What was the first financial statement that we discussed under the financial performance analysis? Please name out that first financial statement. Balance sheet, very good. What are the 3-4 aspects that you require to keep in your mind while evaluating balance sheet? While evaluating balance sheet, what are the 3-4 aspects you require to keep in your mind? And that is going to help you just to check the financial performance of any project or any company based on that 3-4 aspects under the balance sheet. Well, first was the net worth, if you remember. Second was the debt level, change of debt, very good. Third is receivables, and fourth is payable. So these are the 4 things which you require to keep in your mind. All of you are right. Net worth, account receivable, accounts payable, and change in debt level. Okay, what was the second statement that we discussed after the balance sheet? P&L statement, very good. Jasima, you're right. And what are the 3 margins you require to keep in your mind while analyzing performance in a company or for any particular project? 3 margins under the income statement or the P&L statement. 3 margins. First is gross margin, second is operating margin, and the third one is net income margin or the profit margin. So gross margin is nothing but revenue minus COGS or OPEX. Okay, so you are likely to get gross margin. operating margin you can get by deducting sales and admin expenditure, depreciation, R&D, and other deduction from operating margin, from gross margin. So we are likely to get operating margin. And finally, operating margin is also called as EBIT, earning before interest and tax. And from that earning before interest and tax, if we can deduct interest and tax, we are likely to get PAT. So that was the second statement. And this is the third statement, cash flow statement. So cash flow statement can be prepared based on three types of activities. Which are these three types of activities? Just type your answer in chat window. Which are the three types of activities under the cash flow statement that you require to keep in your mind? Well, it's already mentioned in the slide. First is operating activities, second is investing activities, and third is financial activities or financing activities. Superb. So let's go for poll question number 2. And the poll question number 2 is, which financial statement or statements is or are preferred in your firm for financial performance analysis? And for that, let me take you to the poll question number 2. I hope you have kept your menti.com website open and you can type this code and please start answering the question. So all three financial statement, that's what 6 participants, 9 participants, 10 participants, and 1 participant has given cash flow statement. Yeah, I'm waiting for a few more response. Okay, so majority of you are saying that all the three financial statements, that is balance sheet, P&L statement, and cash flow statement. So far, 18 participants have replied. Yeah, I can see 60 participants have joined the meeting. So others, please reply. I'm waiting for your reply. Other participants, those who have not replied so far. Okay, so the poll result is there in front of you, and you can see that majority of the participants are saying all the three financial statements, and all of you are right, because all the three financial statements give a holistic idea of your project. Thank you all the participants for your response, and please keep this particular website open, because this website we will be using for other questions also. So let's go to the next part of our discussion, and the next part of our discussion is the working capital management. Well, what can I say about this area? This is one of the most important area, and these are three facets you require to focus at the time of working capital competition, that is inventory, collections, and the payment. And if you remember, we discussed this, that inventory, collection, and payments we discussed. Can you please tell me this three part we discussed under which financial statement in the previous discussion? This inventory, collection, and payment is part of which financial statement? Cash flow statement, P&L statement, or the balance sheet? Balance sheet, all of you are right. So we need to take a deep dive in balance sheet, and then you can understand what is inventory, what is collection, what is payment. So the bigger question for all of us is that why we require working capital? Well, working capital, okay, the cash is like a blood. Without blood, no human being can live the life. In similar manner, without cash, no business can survive. So where this cash or where this working capital being used? So it is being used for procuring inventory. And if you remember, we discussed about inventory. So can you please tell me what are the three stages of inventory? Inventory comprises of which three components? If you can type answer in the chat window. Inventory comprises of which three components? Very good. So Jayasima has given the perfect answer, and so is other participants. Raw material, semi-finished good, it is also called as a WIP, and finally the finished good. Superb. All of you understood. Superb. So first is procuring inventory. Second is to make payment to various trade payable partners. Now from here onwards in working capital management discussion, we will be using this word. Please remember this carefully. Trade payable partners. Trade payable partners means they are your ecosystem partners who have given some credit to you, and within that credit period, we are supposed to make payment. So it could be your material supplier, it could be your vendor, it could be your subcontractor, it could be the service provider, it could be the logistic partner. I mean, whosoever who are your trade payable partner who are offering credit to you, to your company, that is called as payment to your vendor, supplier, subcontractor, and this list is quite endless in nature. Third is we require to take care about various types of expense in our project. It could be direct cost, indirect cost, overhead cost, fixed cost. All this cost point we will discuss under the next portion under the cost monitoring and control. So this is what the third portion that we require to consider, and the fourth is various types of taxes that we need to pay in the form of corporate tax, in terms of GST, in terms of the other types of applicable tax in your respective country. So in short, you have to have ample amount of cash so that you can take care about these various types of the payment obligation in form of inventory, in terms of payment to your trade payable partners, various types of expense, and finally in form of corporate tax in terms of other types of tax that you are paying to your respective government. So how to define working capital? In layman's term, working capital is nothing but basically the money that you require to run your day-to-day project or business activities. What do you think? Day-to-day, where we spend to run our business or project. If you can tell me some components or some idea where you spend almost on day in, day out. Can you please suggest your daily spending components or daily spending requirements? Please hurry up. Please give your answer. On daily basis, where we spend. It is also called as running expenditure. It is also called as operating expenditure. Okay, Tamodar has given answer. Food, yeah, food can be also one of the expense, but don't forget material, don't forget salary, don't forget utilities, don't forget site expense, don't forget office expense, don't forget, the payment to the labor, payment to the subcontractor, payment to the vendor. These are basically called as OPEX. OPEX. OPEX stands for operating expenditure. For the manufacturing firm, it is called as COGS, cost of goods sold. So that is called working capital. You have to have enough money in your hand so that you can take care about your daily spending. Now, how to compute how much money you require so that you will not default in terms of payment. Now, that can be find out based on different of current assets with current liabilities. So working capital can be computed by taking difference of current assets from current liabilities. Now, let's go for question number 3. Question number 3. And question number 3 is, what is the objective of your working capital management in your firm? Please start responding to this question on menti.com. So far only one candidate has replied all of above. I'm waiting for others to reply. So as of now, most of you are suggesting all of above. means all the options which was mentioned in this question. Good. So far picture is really good, and as per the most of the opinion, and as per this opinion poll result as of now, some 20 participants replied, 14 participants replied all of above, 5 participants are saying managing inventory, receivables and payable, 1 participant has preferred managing liquidity and profitability. So I'll go with majority of your answer, all of above. All of above means all the options, and that's the reason that now you can understand the importance of working capital management. This is one of the crucial aspect that you require to have in your mind, and accordingly you can decide the fate of financial performance of your project or for your company. Thank you all the participants. Now let's go back to our presentation. So if you go by the typical balance sheet which we discussed under the balance sheet discussion, let's focus about current assets and current liability. So the difference of current assets and current liability is called as a net working capital. There are two possibilities of net working capital: positive working capital or negative working capital. What the interpretation of this? Positive working capital means what, and negative working capital means what? Positive working capital means current asset is more than the current liability. It means you are not going to get defaulted because of want of money, because ample amount of money is lying in form of current assets and lesser amount of outstanding is lying in form of current liabilities. If you are a vendor, then should you look out positive working capital for your customer or negative working capital for your customer? If you are a vendor, for your betterment, should you go and prefer a customer which has got a positive net working capital or the negative net working capital? Please answer. If you are a vendor, I'm waiting for your reply. If you are a vendor, should you prefer? Very good. Azaz is right. You should prefer a positive net working capital type of customer, because if your customer is having positive net working capital, at least you can have a sigh of relief that your customer is not going to default it because of want of fund. And madam, you are right, you also record watch out of negative, and if your customer is going towards negative, maybe your customer is having short-term solvency default risk, and the short-term solvency default risk is maximum. So in that scenario, you can expect that your customer will default in honoring payment commitment that your customer is committed to you, and your money is likely to get stuck. So at the time of working capital analysis, please keep these 2 points in your mind, but that is not the only point we are going to discuss in the coming discussion. Current assets and current liability, the difference is going to give you idea about the net working capital, either of positive or negative, that is required to be analyzed. Now, if we just go by the current asset components for project perspective, so these are the components of current assets for a project. What current asset component we discussed in the balance sheet, that was for the company. Here the current asset distribution is there for the project. So you can see that the raw material which is lying in your store, which you have yet not assured, that is called as inventory stock, in form of construction raw material, consumable, spare parts, or whatever the other thing that you are keeping in your project store or warehouse. Once you issue it, then it is called as the semi-finished good or work in progress. And finally the finished good, which is ready but yet to be billed to the customer. Once you bill to the customer, until you are not getting recovery of that money from the customer, it is called as outstanding. And this outstanding payment we discuss in the balance sheet in form of debtors, if you remember. Can you recall debtors? Debtors, something which we discussed under the corporate balance sheet. DEBOTOR, debtors. Debtors are nothing but outstanding from customer. Outstanding from customer. And this outstanding from customer is called as a part of current assets. Then advance paid to the vendor, supplier, subcontractors, which we discuss in form of prepaid expense. And finally, whatever the cash and bank deposit that you have. So how many of you, if you have seen in your project that how many of you are having current assets in line with this distribution? Debtors are nothing but outstanding payment from the customers, as we discussed. Debtor is more familiar word in the corporate balance sheet, but for the project balance sheet under the current asset, it is called as outstanding from customer. So how many of you have seen this type of current asset distribution in your project? I'm hoping that you must have seen this in your current project. The next is current liabilities. And under the current liabilities, you can divide your current liability in this variety of distribution: bank overdraft, vendor balance. If you already made a payment to the vendor in form of advance, and that advance paid to the vendor, supplier, subcontractor is always part of current assets. And whatever the balance payment is there, that is called as vendor balance, supplier balance, or subcontractor balance. And finally, the creditors and payables. Now, creditors are nothing but if you are getting credit from your vendor, supplier, subcontractor. So debtor was for the customer, which is part of current asset, and creditor as a word is popular for your trade payable partner. I mean, vendor, supplier, subcontractor. So these are the two words which we discuss in the balance sheet, and the same two words are there in this working capital discussion. And finally, the unadjusted customer advance. If you only take an advance from customer, that is part of your current liability, which is likely to be adjusted against your milestone payments. And finally, the work done but not paid, which is called as a disputed item. If there is a scope dispute, or if there is some other workfront dispute, so till that disputed item is not being considered by your customer as a part of your scope, till that period of time, it is going to be part of current liabilities. So if you question in any of this point, you can raise your question. So how to compute working capital cost? The working capital cost can be computed with this three-step process. Step number one is estimating the working capital quantity. Now, this quantity should be estimated by quantity surveyor. Now, the quantity surveyor is going to understand your scope, understand the assumptions, understand the customer requirement, and accordingly, the material quantity and other project activity quantity being estimated by quantity surveyor. Then comes the cost of this quantity, which is being estimated by a cost estimator. And finally, that two steps helps us in terms of forming up working capital cost. So this working capital cost is nothing but that cost depends on two further subtype of cost. That is ordering cost and carrying cost. So what is ordering cost? Suppose you are sending your purchase request into your supply chain management cell or the procurement cell. Your PR is likely to be converted by inform PO by your supply chain management cell. So the processing of PR to PO and then awarding of that PO to the vendor supplier is going to take some time of your procurement cell, and then the further, the activity being performed by your procurement cell in terms of the follow up with the vendor, inspection of vendor, till you make payment to that particular vendor. So that complete cost is called as ordering cost. And once you receive that material from your vendor, you require to keep that material at your project site. So it's a project insurance cost, safety, security, then other types of costs that you require to consider: fire, pilferage, theft, and whatnot. That is basically part of carrying cost. So this two cost is going to decide your working capital cost. That's the ordering cost as well as carrying cost. So how many of you have seen this ordering cost and carrying cost in your project, which is part of working capital cost in your projects? Are you aware about the ordering cost? I told you what are the different things that you require to consider the ordering cost and the carrying cost. Just give your answer in either yes or no. Are you aware about ordering and carrying cost? Well, I'm waiting for your reply. If you can just type either in yes or no. Okay, so most of you are not aware. So this is what one of the home project assignment that you can carry in terms of identifying these two costs. Okay, let me repeat because one participant has requested for repeating. Ordering cost means moment you float your requirement being end user, that requirement is there in form of purchase requisite. PR being processed in terms of PO purchase order, then awarding of that PO by your procurement cell to various vendor. Not only that, but follow up with the vendor, inspection of vendor until you finally make the payment to the vendor. So till that period of time, your procurement cell remains in touch, and that's why that cost is called as ordering cost. Once you receive that material from your vendor, then you require to keep it at your project site. So insurance, security, and then similar types of other costs that you need to consider like fire, pilferage, theft, and whatnot. So that's basically part of carrying cost. Clear? So this becomes a good investigation point from all of you that working capital cost, please remember, comprises of ordering cost and carrying cost, and then accordingly you can find out the total working capital cost. Please study this for your respective project. Now let me explain the working capital cycle. Let me explain the working capital cycle. So this working capital cycle starts with deployment of cash by you in form of a payment to your raw material supplier. Now what happens here, before you deploy the cash, your raw material supplier has given some credit period to you, and that period, credit period can be called as a payable period, 30, 40, 50 days, whatever it may be. And that's why it is called as accounts payable period. Depends on your credit policy that you agree with your raw material supplier. Moment you make the payment to your raw material supplier, it's the beginning of your working capital cycle. Then you are converting your raw material in terms of WIP. So here you are adding value. And then finally WIP is getting converted in terms of finished goods. Okay. And once you complete your finished good, obviously you want to bill it to your customer. So once you bill it to your customer, it is called as a sales. But sales has not given you the revenue, because between sales and revenue, we are likely to give credit period to our customer, 30, 40, 50 days of credit period. That 30, 40, 50 days of credit period can be called as accounts receivable period. Here it was accounts payable period, credit that we enjoyed from raw material supplier. Here we are allowing our customer to enjoy credit of 30, 40 days. Once you recover that amount from your customer, you are taking out your profit, and the same cycle is going to repeat. You are flowing back the same money, and likewise this cycle will repeat. So in order to minimize your working capital, the cycle period should be as less as possible. Cycle period should be as less as possible. So one participant has asked question, what is WIP? WIP stands for work in progress, and this work in progress is nothing but semi-finished activities or semi-finished goods. Clear to all of you? So your job is to compute the working capital cycle, and your objective to optimizing the working capital is you can repeat maximum number of working capital cycle in a year or in a month. So that can be found out based on the length of this working capital cycle. Now, how to compute working capital cycle? Because the previous slide was basically the schematic diagram of working capital cycle. In order to compute the working capital cycle, we can use this equation, and this equation is WCC is combination of DSO plus DWO minus DPO. Let me explain one by one. DSO stands for days of sales outstanding, and that can be computed by taking 365, that is number of days in a year, multiplication of average account receivable. So what do you mean by average account receivable? Suppose account receivable for the month of March is X. You also need to go for account receivable for the month of Feb, and then you will average it out by adding Feb and March receivable divided by 2. Why we are doing this? So that whatever the aberration is there in the month of March, that can be easily avoided by taking the previous month receivable picture And that's how you can get average accounts receivable divided by total sales. Total sales is nothing but your invoice value for the month of March. For the month of March. And that's why it is called as total sales. That is for DSO. For DWO, same thing. But in place of accounts receivable, we are going by inventory, average value of inventory. So here also the same thing. That is March month inventory and the Feb month inventory. You will add and you divide with 2, you will get average inventory divided by total cost. Total cost is nothing but it's basically COGS if you are from manufacturing firm, or it is OPEX if you are from project firm. So what do you think? What are the different components which you would like to consider under the COGS or operating expenditure? We discussed it several times. What are the components which will come under the total cost? Please hurry up. Answer this question. Material cost, salary, very good. Second, labor payment and other running expenditure like utilities and services and securities and whatnot. Jayasima, you are right. So that is basically the total cost. So that is DWO minus DPO. Minus DPO. So why we are deducting DPO? Because this is what basically the credit we are enjoying from our vendor, supplier, subcontractor. So number of days in period 365 multiplication of accounts, average accounts payable divided by total cost. So if your WCC is negative, WCC is mentioned here, Mansoor, it is working capital cycle. Working capital cycle. Okay. So if WCC is coming negative, what it indicates? And if WCC is coming positive, what it indicates? My question is very simple and straightforward. If WCC is positive based on this equation, what it interprets? And if WCC is negative, what it interprets? Please hurry up, give your answer. If working capital cycle is positive, if working capital cycle is negative, what it interprets? Very good. If negative, it means your customer is enjoying your cash, and it is also called in layman's language, your customer is doing business with your money. So in order to select any customer, please study this. If WCC is negative, it indicates that customer may be struggling in terms of honoring payment commitment. That's why DPO might be more. And that's the reason that WCC required to be evaluated at regular interval. And because of this, in the safety of ecosystem partner, WCC should be positive. But if WCC is too much of positive, then it indicates that too much of working capital being stuck in your project, and that is not a good sign. So you require optimum level of working capital. Ideally, the working capital cycle usually is there between 12 days to 30 days. If it goes beyond 30 days, it indicates that your working capital cycle is extended beyond a month. So ideally, this is what the range you should prefer, and that's what the range you are going to find in any part of your company. So you can also calculate the same thing for your company. Please keep this in your mind between 12 days to 30 days. And that is something in the name of working capital cycle. Now, what are the different areas? What are the different areas that you require to keep in your mind for optimizing the working capital? So 4 areas are there, 2 areas are there in the slide. First is the smart receivable management, so that within the receivable management, you will try to find out your total accumulated outstanding and how this outstanding can be computed. Suppose you are given credit period of 30 days and your customer has not cleared payment in 30 days, and currently the 48 days is running. So your customer has overshot it by 10 more days, and because of 10 more days of the late recovery that you're expecting from your customer, there is a provision in most of the contract, and that provision which is there in the contract clause is late payment interest penalty clause. Are you aware about late payment interest penalty clause? which is usually there in the contract between you and your customer. So you can exercise that clause, and for exercising that clause, you require to keep all this record that credit period was 30 days, you received that payment on 48 days, so you can impose, as per the contractual provision, late payment of 10 days in terms of interest penalty. Now, in order to do this, you require to keep your vigilant eye in terms of your outstanding or in terms of the recovery, and that is going to minimize your working capital, as we discussed in the working capital cycle. Point number 2 is the liquidity management. And another liquidity management, as we discussed, that from where money comes, where money goes, and finally the net cash flow, that is inflow minus outflow, is liquidity. It is difficult for any project, it is difficult for any business to have liquidity every time available in your project. So there are some instances your liquidity will dry down completely, and then it is called as a temporary cash crunch. Whenever you face temporary cash crunch, you require to borrow money from your lender, and accordingly you can relieve some of the liquidity crunch situation, and that depends on how smartly you are managing your liquidity, and that is going to give positive impetus to your working capital. The remaining two areas are inventory management and payable management. And under the inventory management, you require to identify the slow moving inventory. Now, what do you mean by slow moving inventory? Well, inventory should make a stage progression from raw material to WIP and WIP to the finished good. If the inventory is getting stuck up either between raw material and WIP or WIP and finished good, you can't bill it to the customer. So you require to identify the slow moving inventory in your project, and that is what point number 3. You have to have efficient inventory management, and the fourth is the payable management. And under the payable management, you should ensure that you will not defaulted in honoring the payment commitment to the vendor, supplier, subcontractor. So that is something about the payable management. So these are the 4 areas which you require to keep in your mind. So if you have to give priority, what do you think? What is the priority which you can keep in your mind in optimizing the working capital out of these 4 areas? What should be your first priority? What should the first priority between receivable, liquidity, inventory, and payable management? And this priority list you need to suggest based on your influence. First is inventory management, Farooq. Why? Because inventory is like a low-hanging fruit. It is there in your control, okay? And that's how, before you think about receivable, before you think about payable, first and foremost thing is inventory. Focus on your inventory. Second is focus is on your liquidity. Third is, of course, receivables, and fourth is something about payable. So the third and fourth order can go up and down, depends on your requirement. But first is inventory, second is liquidity, third either between receivable and payable, and likewise for the fourth one. Is it clear to all of you? Because inventory is like a low-hanging fruit, and if you can smartly manage inventory, you can easily manage liquidity, and then you can request to your customer for clearing your dues in terms of outstanding, and find the payable management. Okay, so with this, let's go to poll question number 4. Poll question number 4. And here is the poll question number 4 in front of you. Yeah, please answer this question. What is your firm's credit policy? And the 4 answers are there. Please start putting your response. So right now, the limited credit with frequent checks, no credit. So out of 5, okay, 7 candidates, 5 candidates have given limited credit with frequent checks. And in this question, we are getting mixed response, but so far, option number 2, majority of the participants are preferring limited credit with frequent checks, and that's what basically the right approach. Frequent checks in the sense of depends on the condition of your customer, and as we discussed under the financial performance analysis, if your condition is deteriorating, then you require to start withdrawing this limited credit. And that's a better option. I would say maybe safe option. Number one, open credit, that's basically too risky. Restricted credit, you may not get enough buyers in that. And no credit, it means if you see a monopoly business, then you can go for no credit. So I'll go with majority of the respondents, and majority of poll respondents have given option number 2, and that is limited credit with regular check or the frequent checks. Okay, so after this, let's again go back to our presentation. And now we are entering to the last portion of our discussion. Very interesting, and there is something about cost monitoring and control in projects. And as I told you earlier, this we are going to discuss in line with PMBOK chapter number 7. Chapter number 7 is project cost management. So if you have to just define cost, well, cost is nothing but an expense being spent to build project or for delivering services. Say, for example, if you are a material supplier, then whatever the cost you incur in terms of supplying material. So that's basically the services that you are delivering. If you are a contractor, then what you spend in building project then be called as expense. So project cost is basically an expense being spent by a contractor in various cost element. First cost element is labor. Second cost element is material. Third cost element is P&M, that sometimes we used to call plant and machinery, or it is also called as equipment. Fourth is the borrowing, if you've taken either from a customer or if you've taken from your lender, that is called as the financing. Then comes the services and utilities. And finally, contractor is also adding their part of overheads and the profit. So this is basically the complete invoice value. And within the invoice value, not only we consider a cost from the contractor perspective, but overheads and the profit. Now, being a project professional, this information is useful to you in terms of formulating the plan, and accordingly you can take some corrective monitoring and control actions. So this is the dictionary definition of cost. Now let me take you to a pie chart. And before I explain to the pie chart, as I told you earlier in the working capital discussion earlier, project cost can be divided in multiple categories: fixed cost, variable cost, direct cost, indirect cost, and overhead cost. And if you add all the 4 types of cost, it is called as cost baseline. And this cost baseline is nothing but, you must be familiar with the cost as curvature. Are you aware about cost as curvature? Cost as curvature is having English alphabeting S character. That's why it is called as cost as curvature, which is being plotted in a cumulative form. That's how it is called as the cost as curvature. Cost as curvature will tell you what is the allowed spending. And depends on your actual spending, you can find out that where your project is heading. So this is something about cost as curvature. Now here you can see that in this pie chart, this is, imagine that this is your project contract, and this project contract, or the maybe month wise if we can discuss, this is your project invoice value. Within the project invoice value, this percentage distribution is only an example. It could vary from project to project and from customer to customer. The biggest is the material cost. Second is the subcontracting charges. Then comes other operating expenditure. Then comes staff cost, and then comes the admin and the sales expenditure. If you deduct this, we are likely to get operating margin. And from operating margin, you can deduct interest, tax, depreciation, and amortization. We are likely to get net profit margin. So at the time of assessing the project performance on the cost front, how many of you are using this type of pie chart? How many of you are aware about this pie chart, which is quite common during the proposal stage, which is quite common at the time of cost monitoring and control decisions? Have you seen this pie chart in your project? Have you seen this type of pie chart in your project? Just type your answer either in yes or no. Okay, so Nawaz has given yes answer, and Nawaz, can I consider maybe same types of percent distributions are there in your project, or is it a bit different than the percentage which is mentioned in the slide? Okay, so maybe you are not aware. Similar, so that's what Nawaz has given the answer. So at the time of submitting a bid, contract is usually preparing this type of pie chart, and that gives a fair idea that where we are going to spend, either in the name of material, on the name of subcontracting, on the name of salaries and whatnot. And actually when you spend, you can map it, you can compare it, what was the proposal stage pie chart and what is the actual stage pie chart, and just by doing a comparison you can find out apple to apple, like material cost, proposal stage material cost, execution stage material cost, and likewise for other areas. Now let's go to the charter, and this charter is having four different areas. In these four different areas are the resource planning, cost estimating, cost budgeting, and cost control. Let me explain one by one, and then I'll also tell you that during which stage of the project this activity is being formed up as per this project cost management charter. Resource planning means you require to understand the scope of your project based on the bid and the tender document, and then you require to identify various resource requirement in terms of LMP. LMP analysis is basically carried out under the resource planning. So are you aware about the full form of LMP, LMP analysis? What does LMP stand for? LMP is basically three types of resources that you require. LMP. Are you not aware about LMP? L stands for labor, M stands for material, P stands for plant and machinery. So what skill set or what category of labor or the human resources that you want, what type of material of which specification that you want, and the same thing about the equipment or the plant and machinery. Am I right? You should be doing this under the resource planning. How many of you are doing this LMP analysis under the resource planning? Just give your answer. Yeah. How many of you are doing the LMP analysis? Just give your answer under the resource planning. So L stand for labor, M stand for material, and P stand for plant and machinery. So this is basically the resource planning, and the resource planning is being carried out during the planning stage of proposal. Then comes cost estimating. Under the cost estimating, we are estimating the cost, and this job being done by the cost estimator. So estimation of various types of cost of various types of resources, I mean for the labor, for material, for the P&M, and then it gives you the idea that what is the overall spending that we can do. So the cost estimating inputs being imbibed under the cost budgeting, and here you require to use various types of index like inflation rate, like labor index. Okay, because labor salary structures vary from country to country, because there are sometimes the local hiring requirement is there, and the inflation rate which consider the commodity price and whatnot. So the adjustment is getting done between the cost estimating and budgeting, and finally the cost budgeting, you get a complete idea about what will be the cost of this particular project. Now, along with the cost, we are also adding our profit, and then finally we submit to the customer, and that is our bid price. If customer has accepted the bid price, then we require to start the execution, and here comes the cost control. So you can see the connection of these four types of activities in this project cost management charter in the project life cycle. What does I, E, and C stand for in this project life cycle? What is the full form of I, E, and C? Please tell me. Initiating, very good. E stand for execution, superb, and C stand for commissioning and closeout, not control. Okay, commissioning and closeout and handover, because control is already part of execution. So I stand for initiating or initiation, E stand for execution, and C stand for commissioning and close out. Okay, so before you start execution, we would have got the bid outcome for the bid we submitted to the customer. Suppose if you are successful winner of that particular bid, and if this bid being awarded by a customer to us, then we require to start execution. And between execution and commissioning and closeout, we require to do controlling. So this is as per project cost management charter. I am sure that you must have crafted this project cost management charter at your company level or maybe at your project level. How many of you have seen this charter in your project or maybe in your company? Are you aware about this charter? That's what my question is. Have you seen this charter in your project, in your company? Please answer either in yes or no. If you don't know, just type no. If you are aware, you can type yes answer. Okay, some of you are aware, some of you are not aware, but this is compulsory for anybody of project. You have to have this type of charter. Now let's go to the poll question number 5. And as per poll question number 5, here's the question. And the question is pretty simple. What is the objective of project cost management in your firm? And you can see 4 answers. You can select any of this answer or combination of answers that you want. Please submit your response. Please submit your response. So most of you are using cost management, and that is rightly so, for monitoring and controlling of project cost. Some of you are also using for profitability management, for activity or resource management, and I think 2-3 participants also suggesting for forecasting and trading for the balance scope of work. All of you are right, but the prime objective of this project cost management is the first one, that is monitoring and control of project cost. I'm not, I'm not telling that the other possibilities are not there. Other possibilities are also there in terms of managing profitability or managing activities and finally forecasting and trading. But the prime objective is monitoring and controlling of project cost. Fantastic. Thank you all the participants for your candid response. Now let's go back to our presentation. And as per the presentation, what is project cost control? Now before you go to the project cost control, let's define project control. So project control is, the continuous process, and with the help of this project control, we can get a fair idea of deviation of actual performance from the planned performance. Now, planned performance, if you remember, we discussed in terms of time, cost, and quality, and these are the 3 corners of project performance triangle. So, with respect to time, if your actual project time is more, it indicates that your project is running behind schedule. Cost-wise, if your project is spending more, then you can probably tell that your project is overspending. And quality wise, if you are compromising or if you are a bit far away from customers' expectation, then you can also get idea that how your actual performance with respect to the planned performance on quality front. So these are the 3 corners of effective project performance triangle, that is time, cost, or scope or quality, whatever it may be. And in order to measure the project performance based on this 3 corner of project performance triangle, this is called as project control. Within that, project cost control is basically useful for this 3 aspects. First and foremost thing, monitoring the cost performance. And under the monitoring the cost performance, we require to compare the actual cost with the planned cost. And if actual cost is more than the planned cost, it means cost wise we are overspending. And cost wise, if you are overspending, it indicates that somewhere problem lies. So we require to investigate what is going wrong, and accordingly we require to find out its solution. Point number 2, updating the cost management plan. If you remember that we discussed under the cost as curvature, and incorporated authorized scope change which we are receiving from customer. So say for an example, today if your scope being upwardly revised by your customer, and that notification customer is informing to you with a scope change request, that scope change request you require to imbibe in your current cost management plan, and from tomorrow onward, that is from 12th March 2021 onwards, we require to follow the new revised cost management plan, and that updating work is basically part of project cost control. And finally, the most important thing, we require to inform the project performance to our project stakeholders. And these project stakeholders could be your vendor, supplier, subcontractor, customer, your project team, means anyone who are directly, indirectly getting impacted with your project performance. So that's what point number 3, we require to inform our project stakeholders about our project cost performance. So what do you think, whether these 3 functions are happening under project cost control in your project? Who is responsible for this project cost control in your team? Is there any dedicated person who is responsible for this function? It is whose job? Is it vendor's job, project director's job, customer job, project team member's job, or project control manager job, or project cost controller job? It is whose job? It is the job of project cost controller. It is the job of project cost controller. And project cost controller is working in a dedicated manner. Okay. So let's see how this job can be performed. So there is one method, and I'm hoping that most of you are aware about this method. The name of the method is earned value management. So let's see the earned value management. This method is not new method. This method is at least 40-50 years old, and this method is successfully currently being practiced in most of the construction EPC projects. And even in IT industry also, you are going to find application of earned value management. Meaning of earned value within this earned value management is the progress or the percentage of completeness that you observe at any period of time whenever you take a review of your project. So your actual progress is called as earned value, and the planned progress is called as a planned value. That point we'll discuss in the various EVM terms in the next slide. So earned value is nothing but your actual progress or the percentage of completeness. Now, why EVM is most preferable monitoring a control technique? Because EVM tells you the 3-dimensional performance idea. And this 3-dimensional performance idea are, where have we been so far? It means your past performance. Second is, where are we now in terms of current performance? And based on past performance and current performance, we can get progress productivity idea and spending idea. So based on the productivity and spending idea, we can go for forecasting the future, and that is, where are we going? So again, let me repeat, where have we been so far is the past performance. Where are we now is the current performance. Based on this two, you can get a productivity and your spending idea. Based on productivity and spending idea, you can forecast for the balance scope of work, means where my project is heading with respect to time, with respect to cost, and with respect to scope and quality. And because of this, EVM integrates 3 corners of effective project performance triangle, that is cost, scope, and schedule. So this is what earned value management. Earned value management tells us something about how the project is with respect to cost, with respect to schedule, as well as with respect to scope. So this is about the genesis of EVM. Now let me make you familiarize about EVM terms. First four EVM terms are planned value, earned value, actual cost, and BAC. And then I'll explain this graph later on. Planned value is the estimated value of work planned at the proposal stage. Earned value is value of work actually accomplished whenever someone is taking a review of your project. And that's why earned value is actual progress, planned value is planned progress. Actual cost is the actual money being spent for achieving earned value. So whatever the money that is being spent, and accordingly we are achieving earned value. So earned value is nothing but it's your milestone invoice value, and planned value is nothing but it's your milestone commitment. So planned value is milestone commitment, and actual invoice value is earned value. In order to achieve the actual invoice value, what actual spending is being done, that is called as actual cost. So this is what the difference between planned value, earned value, and actual cost. Planned value is the milestone commitment that you agreed with your customer. Earned value is the actual progress that we have actually achieved that we want to claim from the customer. And actual cost is the actual money that is being spent so that we can achieve the actual progress in form of earned value. And finally, the BAC is nothing but budgeted at completion, which is nothing but the cumulative planned value. So that is basically your total scope of your project. So I am hoping that all of you understood this first four terms of EVM: PV, EV, AC, and BAC. Any question? If you have any questions, please don't hesitate to ask your question in chat window. Now let me explain about this cost test curvature, which is also called as EVM graph. So x-axis is project time, y-axis is your project cost in cumulative value, and you can see the three curvature. The middle curvature is planned value in a cumulative form. Cumulative means the past data are getting added with each other, and that's how we are getting nice increasing manner curvature for the earned value, for the actual cost, and for the earned value. So for the planned value, for the actual cost, and the earned value. Imagine that we are reviewing our project here on this dotted line, and if today is this vertical line, today is 11th March. Now at the end of 11th March, planned value is here. So this much of scope we should have completed, but actually we have completed this much of scope. So if you take the difference of earned value and planned value, we are getting scope variance. Scope variance wise, you can see that this much of progress we should have completed, but finally we completed this much of progress. So scope wise, my project is running slower. Now what progress I have achieved as on 11th March, that progress your project should have completed in the past. So whatever the time difference is coming between 11th March and maybe somewhere before 11th March, you should have completed the same progress. So this is called as schedule variance. This is called as the scope variance. This is called as schedule variance or the time difference. And earned value means this is what you can claim from your customer, but finally you spend this much. So you're getting cost variance. You are getting cost variance. So cost variance wise, your project is overspending. Scope variance wise, your project is running slow. Schedule variance wise, project is running behind schedule. So here we are getting three types of variance: scope variance, schedule variance, and the cost variance. So these three are basically the new terms over and above PV, EV, AC, and BAC. I hope you understood all the 7 terms. First 4 is PV, EV, AC, BAC. And remaining 3 terms are the schedule variance, scope variance, and cost variance. Any questions if you have it? Okay, the next is over and above the cost variance and schedule variance, 2 types of performance index. That is CPI, cost performance index, and SPI, schedule performance index. So first of all, let's see the interpretation. If CV, cost variance, is negative, it interprets project is over budgeted, means you're spending more than the allowed spending. If CV is positive, it indicates underspending or under budget. So for betterment of all the stakeholders, CV should be always positive. CV should be always positive. Javed Ahmad has asked question, if cost being parked in WIP, how it will be managed? Good question. Until unless you have not made payment to your vendors and supplier, it is not going to be part of your cost booking statement, point number one. And until unless that cost you are not claiming from your customer, it won't be part of your earned value. Is it clear, Javed? So if you already made payment to your vendor, obviously it's a part of actual cost. But if you have not claimed it from your customer, it is not part of earned value. I hope I will clarify your question, Javed. Schedule variance is, it could be negative or positive. Negative means your project is running behind schedule. Positive means your project is running ahead of schedule. So again, for the betterment of all the stakeholders, schedule variance should be positive. Cost variance should be positive. And if cost variance is positive, CPA is likely to be greater than 1. If schedule variance is positive, SPA is likely to be greater than 1. So CPI is having three possibilities. CPI 1, CPI less than 1, CPI less than 1. So if CPI is 1, what it indicates? If cost performance index is 1, what it indicates? Please answer. If CPI is 1, it means you are spending as per your plan, and that's why the cost variance would have been 0. If cost variance is 0, CPI is likely to be 1. If cost variance is positive, CPI is likely to be greater than 1. Same interpretation between SPI and SPI. If SPI is 1, you are on track. If SPI is less than 1, your project is running slower. In that case, SPI would have been negative. If SPI is greater than 1, it indicates your schedule variance would have been positive. So you can see the connection between CV and SPI, sorry, CV and CPI, and SPI and SPI. I hope it is clear to all of you. It is clear to all of you on the name of variance as well as performance index. And finally, forecasting and trending terms. Now there are three forecasting and trending terms. What happens that based on my productivity and spending pattern, you can always forecast for the balance scope of work where the project is heading. And for that, the three terms are there: EAC, ETC, and VAC. EAC is estimated completion. It means amount we expect this project to cost based on where we are related to the cost and schedule. So basically it's a spending and productivity pattern. For that, let's divide BAC with CPI. So here, if I ask very simple question to all of you, if CPI is 1 in this equation, what will happen to EAC? Will it be equivalent to BAC, less than BAC, or greater than BAC? If CPI is 1, if I take CPI equal to 1, what will happen to EAC? Will it be equivalent to BAC, less than BAC, or greater than BAC? Please answer this question. Please answer this question. If CPI is 1, what will happen to EAC? Very simple. EAC and BAC will be same. So now if CPI is greater than 1, it means you are heading for EAC lower than BAC. It indicates what? It indicates that you are heading for underspending, and that is always good for your project. It is always good for your project. So EAC will decide fate of your ETC. So ETC is nothing but EAC minus actual cost. And ETC indicates what? ETC is estimated to completion, and that is how much further we need to spend to complete balance scope of activity. To complete balance scope of activity from here onwards in the future. So ETC will tell you something about the futuristic spending to complete balance scope of activity. EAC is nothing but how much this project is going to cost me in totality. and finally variance at completion. And variance at completion is nothing but BAC minus EAC. Now here you will understand, if both are same, VAC will be 0. If EAC is more than BAC, and that is only possible if CPA is less than 1, variance at completion is negative. And if EAC is lower than BAC, we are likely to get variance at completion positive. This picture is going to get changed moment your productivity, CPA is changing, moment your progress is getting changed. And accordingly, these 3 terms is useful for forecasting your future of your project based on balanced scope of activity. Now let's summarize all the terms that we discussed so far. So here is the EVM term summary, and you can see all the terms we discussed right from PV till VAC. I think this tabular information will help you in terms of defining each term, how to compute in terms of its equation, and finally the interpretation. Most of the things that we discuss. Please go through it and tell me if any doubt, because after this there is one big case study is coming of application of EVM concept in oil and gas wallet platform project. If you have any questions, please put your question in chat window. Okay, so after this, let's go to the case study, and this case study is about one oil and gas wallet platform project. So all of you are from hydrocarbon industry, so there is no need for me to explain what this picture indicates. So this is what the project. And if I just tell you the details of this project, so this EPC company has secured this project from one XYZ client. And if you just go by the scope of work, fabrication of some 16,000 tons of structure steel, then 100,000 inch diameter of piping fabrication, 75 kilometer of cabling work, and 22.5 kilometer of pneumatic tubing. This project was originally planned for 13 months, but this project has seen a month of delay, 1 month of delay. So in place of Feb 16, finally this project got over in March 16. Project contract value was 145 billion. This project is a completed project. So let me tell you month-wise all the EVM terms that we discussed, right from actual cost till variance at completion from Jan 15 till March 16. And if you can specifically focus on this orange patch, and within the orange patch you can see that everything is going down for this project, for the cost front as well as schedule front, and from the scope perspective everything is going down, and that is quite evident from the negative value of CV, SV. And if CV and SV is negative, you can imagine that CPI and SPI is also turning negative, and VAC is turning negative. And you can see that though the project is having 145 million, but you can see EAC is coming 350. This figure is going to get changed because our productivity is improving. You can see from 350, it has gone down to 161. And finally, you can see the total cost is 131.81. So EAC is 139.81 and 145 million. So if you take difference of this two, and that is basically VAC, that is 5.19 million. So you can imagine that this is the page where some sort of root cause analysis is required, and then we can find out why the things are not going right for the project. Now you can see all the values that we computed in the EVM terms, the same values are there with the same equation. And if I just take you to the EVM curvature now, and this is the EVM curvature. If you remember, right from Feb 15 till maybe June, July 15, the progress was not up to the mark because everything went wrong with the project, for the project, cost-wise, schedule-wise, scope-wise. And can you see this? Now, first of all, if I just tell you the red curvature is planned value, blue curvature is actual cost, and the green curvature is earned value. So the blue curvature, actual cost, and the red curvature, planned value, is almost overlapped from Feb 15 till maybe June, July 15. And if you see the earned value curvature is lower. So cost wise, we are overspending because blue curvature is above green curvature. And progress wise, scope wise, project is running slow. Why? Because green curvature is lower than the red curvature. And then green curvature try to match the red curvature, but throughout the project is struggle. But the good thing is happening is on the cost front. So you can see that gradually the actual cost is coming lower compared to the earned value, and that's why the difference between earned value and the actual cost variance wise, it was positive. But this project has struggled throughout the project tenure in terms of schedule. Now, because of this particular project has seen 1 month of delay. Against Feb 16, this project has gone for March 16. Now, if you just go for the case learning of this particular case study, and as you can see that the sign of warning was there between March 15 till June 15, because everything went against this project in terms of cost, in terms of time. And if you can do some sort of root cause analysis, and the prime root cause analysis was that work front was not available, and because of work front was not available, that's the reason that enough the progress could not be achieved. But project contractor has not demobilized the project site, so whatever the resources which were sitting in the idle manner, that would have ballooned the cost. So because the progress was not achieved and the cost was continuously being spent by the contractor, that's why the cost has gone up, and schedule wise not much progress happened. And this is the reason that 1 month of delay is there. So because of this, contractor can think about going for 1 month of EOT, extension of time, and if any LD being imposed by customer on contractor, that can be easily also safeguarded based on this EVM analysis. So you can see that not only you can get the current picture of your project, but you can also forecast the project in terms of the balance scope of activity. And that's why EVM the best tool available mainly for monitoring, control, and forecasting of your project performance. So that's it about the EVM case learning. Finally, let's go for the final poll question. And for that, let me take you to the final poll question. And this is the final poll question. Let's see how you are responding to this final poll question. Please reply to this final poll question. Which project cost monitoring and control technique or the techniques that you used in your firm? Yeah. Please submit your response. Superb. So as of now, out of 14 participants, those who have submitted their the poll preference, 6 participants have preferred EVM, or they are preferring EVM. 4 are preferring cost variance report. 2 are preferring JCR, and 2 are preferring P&L statement. And one participant has given none of the technique which is mentioned above. So maybe the participant must be using something else. So I can go with the majority. Majority of the participants are using EVM, and it's the right answer. Why? Because EVM, you must have realized that EVM is a good monitoring and control tool, which can tell you the past performance, current performance, and based on the past performance and current performance, you can also jot down the productivity and spending pattern that will help you in terms of predicting the future of your project for the balance scope of activity. And especially EVM is useful for EOT and extra claim. So that's what the added advantage of EVM, which I really doubt if you can actually get from P&L or from JCR or from project cost variance report. Super. So thank you once again, participant, for submitting your valuable opinion for this poll. And I think that's it from my side. I completed. If any questions are there, I'm happy to answer your questions. Yeah. Forum is open to all the participants for whatever the questions that you have for any of the point that we discussed so far in last 2.5 hours. Yeah. You can put your question in chat window. You can also ask questions if you want.
I request all the participants to please, post your queries, and you can directly raise your hands and can ask the questions here as well. Forum is open to everyone, as said by Dr. Hiren Maniar. So, I'll request people to post the queries if they have any. And also, one of my colleague, Mr. Jalal, has actually posted a link for submitting your attendance and feedback. I request you all to please put your attendance feedback. It's valuable for us. We'll get to know your learnings, your comments, so that we can improve our upcoming programs. So I'll request you all to please put the feedback. And I again request you all to post the queries if you have any.
Yeah, so few of you have requested for PPT. I will share this PPT with Pratik, and hopefully Pratik will share this PPT with all of you.
Sure, sir. Thank you so much, Hiren sir, for your detailed insight about the topics like financial statements and capital management, and then cost management charter and all those things, followed by extensive case studies which you detailed us about using EVM. Thank you so much for your guidance, sir, and I hope all the participants will definitely be facilitated by this learning, and they can implement in their upcoming projects in the future projects, and they can have a detailed insight of project finance for their particular project. Thank you so much, Dr. Hiren Maniar.
Thank
And
you.
I'll request again the participants to put your valuable feedback using the link posted by my colleague, Mr. Jalal. Thank you, everyone. And a recorded session will also be shared by us to you guys
Yeah.
through the email to all the attendees. Thank you, Dr. Hiren Maniar. Thank you so much.
Thank you, Pratik, and thank you all the participants. And let's hope that again we'll meet in some different form and different programs of LNP IPM. Thank you, and have a nice day to all of you. Thank you.
Thank you, sir. Thank you.